Even in a long bull market, there are such things as beaten down stocks, and 3 of them are bouncing back today on Barron Stories. I'm Jack Otter, editor of Barrons.com. I'm here with Jack Howe, senior editor at the magazine. Let's start with the stock that I'm calling maybe the Trump bounce. It actually got hammered by Trump, E.W. Scripps, because he doesn't need to advertise. He gets free advertising for people like us in the media. And so E.W. Scripps, which relies on this political spending each year, suddenly sees its revenue going down.
Is this the art of the stock market deal here? He's busy on Twitter, so he's not spending money in these battleground states. And it looks like Hillary Clinton's got a pretty big lead in some of these states. The spending isn't, since it's not neck and neck in some of these markets, the spending isn't what investors thought it would be, and the stock has gotten hammered since last November.
These small broadcasters rely every 2 years on getting a lot of political advertising.
Right. They do that, and they also make money from these retransmission fees, which are a stabler form of income. And like many of these media properties, Scripps has below market contracts. It has an opportunity to renegotiate those in the years to come and move this stable income higher. So there's definitely some growth here to be had over the long term for the investor who's looking long term. Too many of them are looking at the short side of the picture now, and they're saying, hey, advertising isn't what we thought it would be, let's kill the stock. And the stock looks cheap here.
So it's a great opportunity to buy that long-term growth just because of the weird political season we're in. And that stock's up 7% today on David Englander's story.
Yeah.
Let's move on to your story, a slightly larger company, Brookdale Senior Living.
Yeah, it's the biggest nationwide player. It sounds unusual to say nationwide player when you're talking about senior living facilities, because it's usually a pretty local business, but this company bought a big competitor, and now they operate in, I think, 47 states. So the key question is this a business where you're really going to see those benefits to scale? I mean, you can cut some costs and things like that, probably save on some real estate costs going forward, but we're waiting to see. Look, it's early to call to make a case for a value in this stock. The stock does look cheap by several different measures. What I like here is that for the first time in about 5 years, the company hosted an investor day where they just began to talk about, hey, here's the plan, here's how we're going to make money. Now, that doesn't necessarily mean that it's a good deal, but it means it's reason to take a look. When a company starts wanting to talk to their investors, then I want to start seeing what they're up to.
It suggests that they probably wouldn't do that if they only had terrible news they didn't want anyone looking.
Right, and they announced some sales. Sales are going to be really key for this company, selling underperforming communities, ones with ones that aren't as full as other communities, ones that have some high spending needs going forward. If they do that, they can make the portfolio more attractive.
They've got a lot of debt.
And the long-term demographics in this business could hardly be better. They need more seniors of means, and if you look forward over the next 5-10 years, there's nothing but seniors of means entering this market, particularly when the baby boomers start moving into these types of facilities.
I don't know if we have means, but we're going to be seniors eventually, Jack, and we're going to need a place like this.
Eventually, yeah.
Let's move on to Verifone in the trader. Vito Racanelli says that this stock is yet a third one that's been hammered, and undeservedly so.
It's trading at a discount to everything, a discount to its own history, a discount to its peers, a discount to whatever you can think of. I guess there's some lumpiness here with the chip cards.
The thing everyone hates.
You need to refresh all these terminals, and they've done that some places. There are holdups in doing it with some of these smaller merchants, but eventually you're going to need to refresh that hardware, especially with more people paying with their smartphones and so forth. So this is a company that's in a good position with plenty of growth going forward, but they've had a hiccup here in the near term with their earnings. They brought down their guidance, and investors just aren't hearing it right now. They want, if you tell the investing public that you've got to bring down your earnings guidance for the year, the next thing you say doesn't matter. Your stock has already been trashed.
It's like swearing in a meeting. It's the only thing they hear. We should point out, for people who don't know, this is a boring company that has a nice steady business, which is when you swipe your Visa or MasterCard, it processes some of the payments, it sells some of the equipment used to process that payment. It's a nice steady business that's not going away.
And an opportunity to get it on the cheap.
Thanks, Jack.
Thank you.